Thank you. Thank you very much, Alexia. That's certainly very true indeed. Thank you very much for inviting me in this prestigious event. Good morning, ladies and gentlemen. What I'd like to do over the next 30 minutes is discuss the broader macroeconomic and geopolitical environment, focusing a little bit more regionally and also locally. And the first set of good news which has come through over the last few days, surprisingly good news, is from the IMF, which tends to be always about negativity and bad news. The IMF came out with a positive upgrade on the world economic growth. 3.2% last year, expectations have increased to 3.6% this year, and for 3.7% in 2018. More importantly for me is that the expected growth is not just in some parts of the world, but it's widespread across both developed and emerging markets. And if we look at the US, whether we look at China, the Eurozone, Africa, emerging markets generally, we're tending to see an increase in those levels of growth with relatively contained inflation. However, if we look at this global economic environment being strong, stable, relatively contained inflationary pressures, what are the risks we need to be aware of? What are the concerns we may need to have? Number one is that central banks around the world have had a concerted effort in keeping monetary policy very easy. Since the financial crisis, quantitative easing, zero interest rate policies have built significantly large balance sheets across the central banks around the world. This is coming to an end. Some central banks will be doing it faster than others. Some central banks have already started. Others may be lagging a little bit behind. But monetary policy divergence is going to be one of the key risks coming in. How will central bankers manage those differences? The other point is that the financial markets, I believe, will also start to see a little bit of volatility coming through. Financial markets have had an easy ride so far over the last few years with the clarity of what central banks will be doing, a clear direction and alignment of policy. This will start to change. So financial markets will also have to be a little bit more attuned to the changes in the macroeconomic policy. Fiscal expansion is something, again, that not so much policymakers but politicians have now need to take care of. The central bankers have managed to provide the broader economic growth through monetary policy. Now that is being passed over to finance ministers, to politicians to take on through fiscal. So fiscal responsibility is also going to be very important for the next sort of 5 to 10 years. What does that mean for central banks? The US Fed, I believe, will continue to raise rates even though inflationary pressures are not there, just in order to provide some support for the next economic downturn. So, in my view, Yellen is the best person to do that. There are concerns that Yellen will be changed by President Trump. One of the potential replacements is Mr. Taylor, who created the Taylor rule. He's going to be more hawkish, and I think that that could be creating a little bit more volatility. But Yellen, I believe, is going to be stable and gradually raising rates end of 2017, but into 2018. As far as the ECB is concerned, the stronger euro has been positive in terms of helping the ECB to keep rates and the monetary stimulus where it is. As you know, the ECB has a lot of internal conflicts with the more hawkish members. Bundesbank Weidemann, the Bundestag generally has been concerned about the zero interest rate policy or aggressive quantitative easing of the ECB. And I believe that the stronger euro is helping the ECB to keep its policy in place because the stronger currency keeps inflation controlled. China, in fact, China right now is having the next plenary session. President Xi is going in for his second fifth-year term in November, and I believe that may be leading into a third term in due course. But China's growth is very clear, moving back towards the 7%. So no changes there from PBOC. And finally, the UK. The UK, as Alexia alluded to, of course, we have the risk of Brexit or what Brexit will mean. The Bank of England cut rates last year straight after the Brexit vote. They may take that back, but it still depends on the developments within the government. It's not very stable in the UK right now, and the biggest fear there is that we could be replaced by a Corbyn government. But as well as the macroeconomic stability and stable economic broad environment, there are the geopolitical risks. Over the last few years, Brexit has been one, clearly with the Eurozone crisis. Brexit is the other. We've had the AFD. We had Le Pen with the concerns of the right-wing resurgence. Here, more recently in Catalonia, we've had broader issues with North Korea, Iran, Russia, Ukraine. All of these events have been taking place over the last few years. And my question to you, for the audience, just to test this first polling question, is what impact do you believe will this global political concerns have in markets and the economies over the medium term? Do you expect there to be significant impact, or no impact, small impact, significant impact, or not at all? So what impact would you expect these global political events as they continue to take place? And whilst you're answering that, just a point I also would like to make is that Hillary Clinton, back in 2011, moved the pivot for the US from the Middle East to Asia. In other words, from a foreign policy point of view, the Asian environment seemed to be more important from the US. Now, I think that's going to be moving back towards the Middle East as more tension will be coming through. So what we seem to have is significant impact and some impact coming in from geopolitical developments, and certainly that is what I would have expected, but it is not. If we go back to the slides, it is not what the markets have been showing. So this little graph here depicts the stock market volatility. It's called the VIX index, and it's a volatility of the S&P 500. And it goes back to 2004, and you will see where the spike is in 2008, 2009. That was the period of the great financial crisis. VIX spiked to 80%. The two peaks after that were the first Greek financial Eurozone crisis and the second, and more recently in the summer of 2015 was the Chinese volatility with the PBOC. Interestingly, the last few years, which is the period we just mentioned, the sort of Ukraine, Iran, North Korea, Brexit, and so on, volatility is not there. The markets have been complacent in terms of the geopolitical risks. They place a lot of reliance on central bankers, and that the economists, the central bankers, the politicians will manage somehow to avoid any economic negatives. That is a risk and a concern. Now let's move a little bit closer to the Eurozone. What does this mean for the Eurozone? What does it mean for this region? And just to give it a little bit of context, I've put together the euro-dollar exchange rate since its inception, and I've broken it down into 6 parts. A is where it started. And what happened in the first period, the first few years of the Eurozone, is the Eurozone started and immediately started to weaken significantly. It fell nearly a third of its value. Why? Because when investors were buying into the euro at the start, they thought they were buying into the Deutschmark. They thought they were buying into the credibility of the Bundesbank. And once it started, they realized what they really bought into was not the euro, was not the Deutschmark, but it was a combination of the Belgian franc and the French franc. And adjusting their expectations to the reality meant that they started to sell the euros, adjusting their views as to what they were holding. That led to concerted central bank intervention to stop the euro from disintegrating, and it took them about a year for that to stabilize and start recovering. And then moving into B, the global exuberance taking place, leading to the financial crisis, the Eurozone crisis, and between D and E, we see in E the US economy recovery taking place, signs of the Fed starting to move interest rates, supporting the dollar, and safe haven flows moving into the US. More recently, which is I've characterized F, is we've seen the strength in the Eurozone. This has been a 2017 event when we saw the euro starting to move higher from 105 to 120 just a few weeks ago in the middle of September, and currently high 117s. And I think this will continue. I would expect the euro to continue strengthening, maybe with a little bit of correction towards year-end as the Fed raises rates and the ECB is a little bit more dovish because of the strength of the euro, but I would expect the story to continue into 2018. So positive on the euro as a currency. Broadly, the economic landscape in the EU, if you were to look at it as a snapshot here, we have shades of green as opposed to shades of grey, and you can see on the eastern part of Europe, as well as Ireland, the stronger elements with the light green depicting stronger economic growth, and the darker green, weaker economic growth. And where we are, Spain shows characteristics of a stronger economy than Portugal, France, Germany, Italy being the laggard. And we'll talk a little bit about that again soon. Let's start from the core. Let's start from Germany. One thing I must mention is my wife is German. I'm Greek. My wife is German. So I've been very much in the center of this whole Grexit and Eurozone crisis. So living in London, Greek, German, has been very interesting for the last few years. But it has also given me a good insight as to the whole Eurozone from a German perspective. And Germany loves the Eurozone. And it's a very practical reason why they've been benefiting significantly from that. The euro, from a German perspective, is a very cheap currency. If the Germans had the Deutschmark, the currency would have been 30, 40% higher than what it is now. So a cheap currency, the euro, compared to what it would have been, helps exports. So they've got a cheap currency, very low unemployment, practically full employment, very low yields, and low inflation. But there are two risks. Risk number one, which we're all aware of, is the AfD, the alternative for Deutschland. And we can see the AfD impact on the right-hand side of the map. This is the eastern part of Germany. That's where the AfD was most strong, in the dark blue. So the next government which comes in place, the next coalition government, will have to deal with the economic, structural, industrial factors to deal with those issues in eastern Germany, so it avoids or manages the AfD impact moving out towards the more traditional western part. You will also see, out of interest, a little bit of blues in Bavaria, which is one of the richest parts, in fact, the richest part of Germany. And that's because this was the avenue from which a lot of immigrants and refugees were coming into Germany, and one of the reasons why Austria has had the latest developments as well. But broadly, AfD is something that they'll need to deal with. Secondly, Merkel's eventual departure. And that is a personal concern of mine, that Merkel has been at the center of this debacle, and she's managed, in a very realpolitik way, managed both Germany and the Eurozone. And my concern is that as and when she leaves, there may be a gap within that area, and it may be very difficult for someone to manage the Eurozone within zone. One exception may be coming from France. And looking into France, the Franco-German relationship has changed. On the left, of course, we have Merkel with Hollande. There was no relationship there after Sarkozy. On the right, we have some signs of positive developments, Macron with Merkel. And I think it's interesting to note that, because Macron came in with a very pragmatist view. He understands that he needs to fix the Franco-German relationship. He came in with some very good suggestions in terms of providing a European budget, introducing a European finance minister. Merkel initially agreed. Now, because of the coalition discussions, she's taking a bit of a step back to reassess before they bring back that discussion. But for me, France, of course, is at the core of the whole European project. France really instigated the whole euro because after 3 wars from 1870 until Second World War, they wanted to make sure that they have Germany close. Keep your friends close and your enemies even closer. So the euro, being part of France and Germany working together, I believe is going to continue working. And in terms of the risks, Le Pen was an example, in a case in point, that Le Pen got the zeitgeist of being anti-establishment and anti-immigrant, but she got wrong the anti-Euro or the anti-EU. And that's, I believe, why she failed in winning the presidency, which went to Macron. And I think this is where Italy is also learning from, and I'll come back to that in a second. So domestic structural reforms will see the continuing growth in French economy, albeit at a lower level than Germany. Spain has been a star performer. Spain has done structural reforms. They've improved on the exporting side, broad-based economic growth, unemployment coming down, including the youth unemployment coming down. And that's one of the reasons why we saw Podemos sort of weaken within the broader economic and political landscape in the region, only to see now the development of the Catalan successionist movement. And this will create uncertainty. This, of course, varies from a political perspective, that from an economic point of view, if Catalonia were to move out of Spain and create a separate country and secede, it won't be in the same way that Scotland leaves from the UK. Because if Brexit takes away the UK and Scotland decides to join back into the European Union, England would not have a problem with that. Scotland can join the EU, England would not say no. Whereas from a Catalonian perspective, if Catalonia were to secede from Spain and try to join the EU, Spain could have a veto. So there could be a very long period of negotiations for that to work. And that is a sort of a worst-case scenario from an economic point of view. I believe what may happen is some sort of a discussion, an amendment to the Constitution over the next 6 to 9 months, which will see some sort of central case scenario taking place. But volatility and economic uncertainty will continue, not at a significant level, but it will have an impact in the region. In terms of Italy, Italy has been the laggard of the Eurozone recently, but even before the Euro was created, Italy was always lagging behind economically, and the only way Italy was growing was devaluing its currency. So devaluing the lira and then helping itself to grow. Now, you cannot do that. And as a result, it seems to be lagging behind and is in requirement of some more structural changes. One other thing about Italy is that the banks still hold just under a third of all the non-performing loans that the EU holds. And it's a significant amount impacting the banks, and it is something which the ECB is trying to address. Also, the political uncertainty. There's always political uncertainty in Italy. Italy has, I can't remember the number, but approximately 50 governments in the Second World War, and that will continue. My key point on that is that with the elections coming in 2018, because of the Eurozone economic growth story taking place, and because Le Pen lost because of her anti-Euro sentiment, I believe that the governments, or the parties which are coming into election 2018, will not play an anti-Euro game or anti-Euro rhetoric. So I don't believe there will be political instability compared to the Eurozone from the Italian elections. And as a result, the spreads or the yields on the left-hand side, I do not expect them to widen, but still remain competitive and low. And the interesting chart is the one in the middle, which shows that Italy is really very two structurally different parts. In the north, nearly full employment. In the south, still very significant high unemployment. Greece is still very much on life support. Yes, it has got some positive growth, expected to grow above 2%, and the best growth in a decade, which is fantastic news. But it's still very much reliant on the underlying funding coming through. The market sentiment has improved. We had a positive €3 billion issuance of bonds. We're seeing unemployment coming down, maybe from part-time, but still positive, and a significant increase in tourism, partly because of the geopolitical sort of issues, the unintended consequences of the geopolitics which support the Greek area. However, again, similar to Italy, there's a lot of non-performing loans which are keeping down the central bank, the banks and the credit facilities. We have middle income and professionals being squeezed because of the left-wing government policies which are impacting on the consumer sentiment, and we have the broader structural issues which need to be addressed, again from a political perspective. But broadly, the economy is stabilizing, is showing signs of positive growth, and I would like to hope that with a broader Eurozone recovery taking place, Greece will also benefit from that. Moving away from the EU now to some of the other sort of key areas in the region, Israel, again, a star from an economic and political perspective. We have seen a broad-based recovery, both export-led growth to the Eurozone, domestic growth. Israel has been increasing significantly. We have seen 4% of growth. We expect that to stabilize around the 3% level. There are relatively differences in terms of poverty because of the Arab Israelis and the Haredi Jews, because of the underlying cultural issues, and the government is trying to assess some of those, improve productivity, and also female participation. Inflation has still remained at zero levels, well below the 1 to 3% target rate by the Bank of Israel, and for that reason I would expect them to maintain an easy monetary policy leading over the next couple of years. So we can see again the 10-year government bond yields in Israel bang in line with the US, and on the right-hand side, a very well-diversified economy, not just focused on one area. Morocco is experiencing sort of a pickup again in the economy after a very difficult 2016. We can see that it's coming back to sort of 4 to 6% level of growth. The central bank has done a very good job in managing expectations, market expectations. We expect a little bit of liberalization on the currency, which will improve some of the structural reforms, but not too fast. They will allow a window, plus or minus 5%, which will be announced gradually. But the reserves have been strengthening, and it puts them in a little bit of a better position. But Morocco is very much reliant on the Eurozone economy, so it's crucial for the Eurozone economy to continue, for that to benefit. And of course, there are the broader geopolitical risks which need to be taken care of. The country which has been doing the most and very difficult, very necessary reforms, but painful, is Egypt. One of the things which Egypt did towards nearly a year ago is liberalize its currency. This is the chart on the right. So the Egyptian pound versus the dollar was allowed to weaken. It weakened significantly. And as a result, if you look at the left chart, this really took inflation to highs where we are now, approximately 30%, just over 30% of inflation. That has led, of course, to hardship in the domestic market. The central bank has had to increase interest rates to 25-year highs, but at the same time, it's providing support to the poorer members of the population by direct support in order to avoid any social unrest. So growth is expected to remain positive into 2018 as this is gradually taking place, and for some stability to come through. Turkey is, I would say, the most difficult in the region. What Turkey is trying to do is balance the domestic situation after the failed coup from last summer. So it's trying to come back from that, and we are seeing consumer sentiment improve and investment come through. But they're fighting the domestic issues with the Kurds, they're fighting the regional issues, and they're also in locked horns with the EU and recently with the US. So Erdogan is fighting on the EU and the US side, regionally and domestically. And this puts Turkey in a very difficult situation. The central bank has been having to sort of keep the Italian lira at play. The lira has been weakening. The positive sign is that at least Erdogan has improved or fixed the relationships with Putin and Russia. Also, their decision to stay close to Qatar when the other countries in the region were very much against Qatar, especially led by Saudi Arabia, that has not had any adverse impact. So there has not been any negativity from Saudi for Turkey, given that preference. And also, Turkey, in fact, has been the second largest. We've seen the second largest inflow of Muslim halal tourists coming in after Malaysia. So there is certainly a market for that within Turkey. But in terms of the EU, discussions are taking place in the EU right now in terms of what to do with the relationship with Turkey. The US has frozen the relationship with Turkey in terms of visas, so that is not positive right now. So the second question for the audience before we move on to the conclusion, what is your biggest concern from the four above? Is it regional politics, Brexit, Catalonia, AfD? Is it global politics, North Korea and Iran, Trump, Russia? Or is it risk of recession if the central banks tighten too fast? Or risk of inflation if central banks tighten too slowly? Yeah. Thank you. I think that shows a clear picture again that geopolitics and regional politics should be driving, and I would tend to agree with that. In terms of my conclusion, I think that we are very much in a benign economic environment with stable inflation coming through. The central bankers are aware of what needs to be done. There's a stronger political commitment into the Eurozone. Yes, there are pockets of uncertainty, of pockets of resurgence, but I believe that a broader and stable economic environment should see that through. The positive reforms in Middle East and North Africa taking place, again, biting a lot of bullets in terms of hard policies and supporting them directly. Russia taking a more active role as the US has stepped back from the Middle East. In fact, it was the first time Russia and Saudi Arabia created a relationship over the last month, triggered through the connection on oil and OPEC. But Russia and Saudi coming through again. So Russia has Iran and also developing some relationship with Saudi Arabia. Low-yielding environment is going to remain gradually, looking for diversified sources of yield. Real yields, of course, in terms of real estate are there, private equity, a lot of interest for that, certainly from the investment community. And the key risk, in my view, from the economic point of view, is central banks not managing their balance sheet appropriately, and in many cases going too quickly in terms of taking off the quantitative easing they have. So thank you very much for listening this morning, and I'd be very happy to answer any questions from any of you. Thank you.
That was fantastic. Can we get some, let's put the questions up on the screen, because I know that we had quite a few of them. So, interesting. I mean, as
First one.
Yeah,
okay,
please.
So is populism caused by the perceived or real failure of capitalism? I think what the central bankers managed to do after the financial crisis is avoid the complete failure of capitalism. If they did not intervene in the way that they had, then I believe it would have been the case. What we certainly know is that capitalism, in the way we thought it was pre-financial crisis, does not work. It had to be much more of an interventionist solution, which happened to be the case. And I do not think we're going to be moving away from that. So yes, I believe that populism is very much on the back of that. It was too extreme, and we're coming a little bit too in the middle. We're not going to go down the China route, but it's somewhere in between rather than what it used to be. So I agree with that. The other question is Greece's recent, oh, sorry, you can see that. Is Greece's recent economics a fundamental improvement with long-term potential, or simply another mini run followed another stumble? No, I believe it is something fundamental. Throughout the whole crisis, I was asked, when you remember, I'm sure a lot of you remember the acronym in PIGS, or PIGS, during the crisis. And everyone was asking me, well, is clearly Ireland and Greece and Portugal, they're all the same? And I said, no, you cannot compare the two. Ireland, to give one example, is 80% economic reason and 20% socio-political. So once the economies improve, that will start lifting off. Greece, on the other hand, was the opposite. It's 80% socio-political and 20% economic. So it'll take longer for this to change. And I do believe we are seeing some changes here. It will take longer than the rest of the Eurozone, but I do believe there are some real fundamental changes taking place. What is the potential of Brexit not happening? I believe it's very low. I wish that was not the case, but I think it is very low. My concern is that this government could risk falling. There's very much infighting within the Conservative Party, and a lot of sort of disagreement as to how it should be, the negotiations should take forward. And I fear that in a few months' time, if the negotiations have not improved, then Corbyn is basically going to say, what have you guys been doing for the last year? We only have 1 year to go. He's going to call general elections, and he's going to come into power. And please don't get me wrong, I don't have any issues with sort of right or left-wing politics. I'm not seeing this as a left or right. My concern is that Corbyn's economics, from what he has been mentioning so far, is moving down the route which cannot be afforded, sort of nationalizing a lot of agencies, something which moves back to inflation and fiscal deficits. So I believe that there's no risk of no happening. It will happen, but it's how messy it's going to be. How much do Donald Trump's policies frighten you? I'd like to believe that what I trust about the US is the way that it's got the sort of the Senate, the House, the Senate, and the Senate, the executive, and the judiciary. So it won't be one president cannot really enact action on himself. He needs to have the buy-in. And I would like to believe that there is going to be some checks and balances like the Founding Fathers sort of envisaged in order to prevent some of the worst cases of what a Trump policies may be. However, and even internally, his disagreements with his own Secretary of State, Rex, shows the signs of uncertainty and volatility, which, in my view, will gradually be reflected in markets. Views on the future of Slovenia and Croatia, again, countries which have been positive, showing clear strategic changes which have been taking place, have been benefiting from the broader Eurozone environment, and I think it's positive within the zone. What would be the impact of impeachment in the US? I'm not sure there will be a risk of impeachment yet. I don't think there's a sign of that. But generally, I would see that as a positive development, given what the broader market economic environment thinks of Trump and his policies. But I don't see that risk coming through. Would Italy benefit from exiting the EU and being able to devaluate the currency? Well, funnily enough, that's what I was alluding to when I mentioned that Italy has always been lagging the economy, lagging the Eurozone economy, and the only way that it would strengthen was by devaluing the lira. So what the Italian government used to do is devalue the lira, grow, stagnant, devalue the lira, grow, stagnant. And they used to do that. So the only way that Italy was growing was devaluing the lira. What did that cause? Inflation. It caused fiscal issues. It caused the huge debts that Italy had. So I don't believe that's a sustainable policy. I don't believe that by exiting the euro, the government would be helpful. In the same way, for Greece, I don't believe that by Greece exiting the euro, it would resolve the structural issues. They need to be resolved structurally from within.
Thanos.
Thank you.
Fantastic. Please, everyone join me thanking Thanos Papasavas. That was
Thank you very much, Alison.
very interesting. Very much appreciated. Thank you, Thanos.